Hello, everyone. This is Lane Aldrich here with First Colony Mortgage. We are in April now, and I wanted to give an update on something that's happened over the last month or so. This brought a lot of calls into my office, and if you're an investor who's constantly looking at different industry news or financing news, you may have already come across this at one point or another. So, a little bit of background. Fannie Mae and Freddie Mac are the two institutions who essentially create the guidelines for investment property financing programs that banks can then offer. Those loans are then, when they are originated and closed, they are packaged and sold into the secondary market and traded as almost a security. And so that's what allows investors to come in to be able to finance properties in bulk and allow a lot of volume. So Fannie Mae and Freddie Mac, when it comes to the Fourplex investment group, these are the loans that we utilize and secure for investors because they're great programs. They allow for 30-year fixed financing. The interest rates are very low. The financing process, as far as the guidelines and the underwriting process, is much easier than a commercial program. So about a month ago, Fannie Mae came out and said, we are reassessing our portfolio and the amount of loans that we are going to allow, and we do not want our portfolio of second homes and investment properties to exceed 7% of all of the loan volume that's originated through these conventional loan channels. Now, historically, those loans on second homes and investment properties for Fannie Mae and Freddie Mac have been in the 11 to 14% range of their portfolio, which means they're asking all of the lenders that originate investment property loans to scale back. And it kind of came out of nowhere. It threw everyone a little bit off guard. But we've spent about a month or so dissecting it, and I want to give an update on what this means to investors. And so when Fannie Mae first came out with this rule, Fannie Mae is in conservatorship with the government. So the Treasury, who's in charge of Fannie Mae or helps make the rules at this point, essentially reached out to Fannie Mae and made them put out this memo. But they reached out to lenders that do a very, very high volume of investment property financing and said, we need you to pull back a little bit. Your numbers are too high. And then they had a round of other lenders that they reached out to that said, here's your warning. And then they had a round of third, essentially, group of lenders where they said, you guys are good, just kind of keep an eye on it. So they have now made all of those phone calls. And First Colony, our company, received a call as well. Our numbers were pretty close to that 7% line. But they essentially said, you need to keep your numbers under 7% moving forward, or else you do not get to originate investment property financing at all. So something lenders are taking very serious. There will be some prioritizing as things calibrate a little bit. When it comes to our company and with FIG loans and FIG investors for individuals coming out of construction to their long-term loan is a major priority for us to be able to take care of FIG investors on these financing. You may have issues trying to do a rate term refinance or a cash out refinance for the next 3 to 6 months on an investment property that is already owned in your portfolio that already has a long-term loan on it. Those are going to be the types of loans that lenders are going to look at and say, we're going to pare back on that for a little bit as we try to get our numbers in line. But it does not mean investment property financing is going away. It means it might be limited in the sense of a scope for the next 3 to 6 months. But what does that mean in the long term? Essentially, investment property financing and investment loans have performed very well for the last 10, 12 years since the recession happened in 2008 to 2011. And so Fannie Mae and Freddie Mac are giving up a large chunk of the market for loans that are performing very well. And so I don't know if it will take 6 months, 12 months, 18 months, but there will be other securities formed where someone's going to come in and capitalize on that piece of the market that Fannie Mae and Freddie Mac just walked away from for no reason, really, essentially, other than they just wanted to recalibrate, what the size of their portfolio was to meet some guidelines deep in their paperwork, or what their representations are to their stockholders. And there might come a time that they may reassess this anyways as well and decide, we're going to open it back up above 7%. Reasons behind their change, essentially, is part of the CARES Act allows tenants to continue to default on rent payments, and also landlords to continue their mortgage payments in forbearance through the end of this year, through the end of 2021. And so I think there might be some question marks there about what that's going to look like when these loans come out of forbearance, or when these tenants are required to reconcile with their landlords, as a lot of states that have been closed continue to reopen. And so it could be temporary in nature. The guidance we've been given so far has actually been very minimal. But for right now, as far as this concerns FIG, it's still business as usual. And if any change comes out that's going to be relevant to the direction on where this needs to go, or that's important to FIG investors, we'll do another update at that point and keep everybody posted.